for me, syndications were checking two key boxes. It's like, is it fully passive truly? Like, do I not have to do anything if I invest, but other competent people will manage the thing for me after I've made my decisions and I've done my diligence? That's the one thing that I sometimes hear gossip from folks in my network. They'll be like, but it's not fully passive. You have to still do diligence. I'd be like, well, same thing with buying a stock.
Yeah.
I hope no one's buying an investment of any type without.
I don't think nothing's that passive where you don't even have to vet it.
Yeah. And so that caveat in place for sure is, I find these investment vehicles to be legitimately passive. There are very few others, at least in the real estate space, can generate cash flow checks monthly that actually hit our account that we can use to pay for our life or any other kinds of investments that we want to make along the way. And then you can still get the growth. So cash flow and growth in one vehicle.
You're listening to the Rich State of Mind Show, the podcast made to make you the total package in the entrepreneurial world and give you what we call a rich state of mind. If you are here looking to learn about real estate investing, marketing, elevating your business, and developing your mindset to get to the next level, then you are at the right place. Stay tuned and be sure to join our community on richstateofmind.com. Now here's your host, Anthony Ritchie.
Hey, how you doing, Spencer? Thank you for taking the time this evening for me, afternoon for you. If you could please tell us a little bit about yourself.
Yeah, thank you so much for having me, Anthony. Really excited to be here. So I'm based out here in the Bay Area, California. I grew up here, spent a good decade out in Colorado, and then came back. I am currently leading Madison Investing. It's a real estate investing company. I actually run it along with my COO, Jennifer Morimoto, who's also my wife. And that's probably a separate podcast. But I think I grew up in a real estate household. My dad was a broker, a residential real estate broker for about 30 years. That had me working in his open houses at a young age. And just to keep it brief, I'll say that scared me into the local business, which is much cooler to tell your friends you work in, which is tech companies. So I ended up doing that for about 13 years. I was building operations groups, sales groups for 5 different software companies over the course of 13 years, mostly in financial tech companies. And now somehow I find myself very, very fortunate to just be leading Madison Investing full time, which is the place where we help folks invest in private funds and real estate syndications and all that stuff. So it's a lot of fun, very different than growing up in the residential real estate, and even more different than growing up professionally in tech companies and unicorns.
Yeah, right. So it's interesting how everything came full circle. You was exposed to real estate at a young age, and then you got away from it, and then you came back, but definitely in a different way. So that's kind of cool. I guess, were you able to apply anything that you learned that your dad taught you, or you kind of it was like riding a bicycle again?
Yeah, that is a really great question. I think consciously at the time, I probably didn't appreciate the lessons he was trying to impart on a more like business acumen front. Mm-hmm. Like telling me about the specifics of the deal and helping me understand the economics of it. I was like, not sure why this matters to me, Dad. That said, I think what sticks with me now more than ever, and certainly than it did at that time, Anthony, is that I used to watch my dad wake up 4:30, 4 o'clock in the morning. And I was so confused. Why would he ever do that? I like, why would anyone ever want to do that? As a teenager who's like, sitting there wanting to go hang out with his friends and just not do work in general. I see that work ethic showing up in my life now. And I see even the way that he would talk to folks, negotiate, work with clients, all that stuff. It's almost like I can hear his voice sometimes coming out in my interactions, So it wasn't necessarily like the biz acumen, because I was probably not appreciating that or giving it due credit. But yeah, there's a lot of those other things, those fundamentals that absolutely influence me today.
Awesome. And so we talked about briefly that you are doing real estate syndication right now. But before anybody even think about something like that, let's talk about you mentioned playing financial offense versus defense. What is that?
Yeah, and this is something that came out very organically just from our household over the past 13 years. So Jennifer, my spouse and co-founder here, she and I had totally different careers. She was our marketing leader. I was like an operations and sales leader in totally different industries. So we were kind of carving our own destiny, did well, worked really hard. We were making good W-2 income, all that stuff. But ultimately, like no matter how good income gets, I mean, we live in an expensive market, admittedly. We live in the Bay Area, so homes out here are just crazy in terms of price points compared to national averages.
Mm-hmm.
Cost of living is high. And I didn't see an off ramp where I could start spending more time with my kids. Number one, I was working 80 to 100 hours in office at a couple of these companies, because that's just what those early startup companies do from a culture and a necessity perspective. But number two is, I mean, we were dumping money into 401k. We were not slacking. I thought we were doing exactly what you're supposed to do. If you work hard, you keep getting progressively more responsibility as you climb the ladder. And then ultimately you realize, wow, okay, I've arrived. And the challenge there was, Anthony, like about 10 years in, I started to get this inkling, like, you know what? At the time, I was particularly working for a really, a bit more of a hardcore culture, like really grinded out style startup that ultimately did really well. But yeah, I didn't see my infant son for about 2 weeks. And I was sitting there going, this can't be the way, like there's got to be a different way to do this, because I didn't see our net worth number moving. The income number was moving, but the net worth number wasn't. So financial offense, to bring it back to your question, was think about things that, how could we think about things that would actually drive us forward in terms of increasing our wealth? And
Okay.
I think that on a fundamental level, I think that a lot of folks tend to, and I certainly used to think about it like, how do I get my income up? Because that just sounds like a necessity, of course. But really what it's about is wealth, like how do you go and build wealth? So I think about it such as adding income streams to our household instead of relying on the two active incomes that my wife and I would have to generate, similar to my dad's income growing up, and this is a side note, Anthony, but it's probably worth mentioning because it's deeply influential to how we run our business and view our family's financial offense playbook today. Is although my dad built up a big business and I was part of that back in the day, this is many years ago now, I watched the lifestyle we had growing up. I watched the quality of life that resulted from our household's one family source of income from his broker business, right? And that business, I mean, like a W-2 job, if you stop working, that income is done. I mean, it's not, there's nothing else coming in. And that actually happened to us for a period of time, because I won't go too far into this TMI style. I'll just say that we went through a thing we call the dark decade. Like lost my younger brother to cancer, my parents got divorced, and like it just series of dominoes, and I think that ultimately resulted in a downsizing of our family in terms of just financial stability. And it taught me a lesson. It really stuck with me. It sticks with me to this day of like, how do I play such solid offense of adding more income streams to my livelihood and to our household, so that if something bad happens to me, God forbid I get hit by a bus, or something significant happens to one of us, that we're still playing and our family will continue regardless of the headwinds in front of us. So that's what I think about financial offense. And that was probably way more wordy than you were asking for, but
no. So I think people needed to hear that, because sometimes, I would say often, these are not just bright ideas that just came out of our heads. These are sometimes experiences that we went through that made us think, okay, how can I make this better? You had to go through the 80, 100-hour work weeks in order to be like, okay, there's got to be a better way we could do this. You had to go through what you went through with your father's business in order for you as an adult now with your own family, you being your own husband yourself now. All right, we could do things better. I learned great work ethic from my father, and he was doing the right thing, right? He was doing the right thing by our family, but I don't want to go through some of the same stressors. You kind of, just to get a little geeky, you made me think about the X-Men Days of Future Past, where the young Xavier is talking to the old Xavier, and he's like, I don't want your future. I don't want your suffering and your pain. And so, like, got it. I'm going to take from you what, the things you've been through, but I want to do it to where I don't experience so much pain and suffering. So completely understand it. And so with that thought process, what made you fall into real estate investing and then going into syndication?
Yeah, well, and thanks for the commentary. And I have to just validate, I don't hear enough comic movie references in the world daily. So thank you. I am a raging nerd. So that is amazing. X-Men was my jam back in the day. So let's see. I got so excited about nerding out, I forgot your question. Now you got to remind me.
I said, with your thought process of, okay, I want to trade time for money, and I want to make sure that I'm spending less time to make, decent amount of money. All right. What made you go into decide real estate, and then even more so syndication? Because there's so many different niches in real estate, but you fell on that ultimately. So
totally. Yeah. And thanks for bringing me back around. I think, I actually found the fifth financial tech company I ended up in, and I just went there because a mentor nudged me toward this place a few years ago. It was actually called, at the time it was called Lending Home. I think they've rebranded, but it was ended up being the biggest fix and flip lender in the country. And I was brought in to lead their loan origination groups. I myself was not a mortgage loan originator, but I did have to go in and earn their respect. I had to get licensed to do that. I had to do all these things to scale what started off as a place that made loans to fix and flippers for single family homes. And some of these were brand new flippers, never done in their life. And they watched HGTV and got fired up and wanted to go try it and not hurt themselves. And the other side, you got high velocity, high volume flippers who were doing parallel deals across the entire country, very established scaled organizations. And so I got thrown into that, and I saw, like, from the inside, we ended up doing 600 or so transactions a month by the time that I was leaving. And that really opened my eyes, on a couple fronts. I'll try to keep this brief, but I'll just say that seeing the economics and the financials and the number of zeros on some of these transactions from the inside. And I'm sitting there going, wow, that person is doing very well for themselves with that deal.
Yeah.
And I'm sitting there going, I find that appealing, obviously, but at the same time, it's not the predictable style that I've come to appreciate as an operations guy, and a guy who likes to do a solid forecast that you can really bet on with some predictability. I also can't swing a hammer at all. So that, I thank YouTube every day for helping me around the house. So, all that to say, I was also hearing the horror stories, not always bad, but just like the war stories about flipping hands-on from the people on my team, because they would literally come in from the weekend prior and they have like cuts on their hands. Because there was a lot of nights and weekends flippers that would come in and work there full time during the day. And I would hear the stories, and it'd be like, we just spent 12 hours Saturday and Sunday scraping popcorn off the ceilings in this unit that we're trying to turn. And they were exhausted and they were kind of tired. They were not feeling it. And sometimes that didn't go well. So I heard all that stuff, and I was like, there's something here. If they can pull this off, then I can pull it off. There's nothing different in terms of my ability to go do this, and I respect, and there's so many amazing examples of people I could call out right now for being just inspiring in what they pulled off and continue to scale on our business. But all that to say, I didn't like the notion of the single family flip thing. We did go through a small real estate investing phase in terms of small properties, though. It inspired us to go buy a local rental. And we spent too much money on it for what we wanted to ultimately achieve. I mean, we didn't understand what it meant to invest for cash flow. And that's really that was game changing for us. Paying $430,000 for a Bay Area duplex, with a loan, for $200 a month in cash flow is not what you call a home run on the cash flow front. It's appreciated, which is great.
Learning experience.
Yeah, learning experience. We still have it now, but we started small, got comfortable with buying out of state. We built a modest portfolio of rentals in the Midwest. So we kind of went through these logical steps of, like, step one, buy local, because that's all we felt comfortable with.
Yes.
Cali is way too expensive. It's not a good cash flow investment. Let's go long distance. Bought long distance. It was more headache than we expected. Good cash flow. Buying a $50,000, $60,000 property for $250 a month in cash flow, that's pretty good. But not if you have to actually take calls to manage the manager on a repeatable basis every single month, and every tenant in every unit decides to leave on an annual basis and increases your expenses. Yes. So all of those things led us to eventually say, like, where's the predictability? Like where's the scale? Where's the predictability? How do we go down and pick a strategy that, like, just made more sense, and an asset class that made more sense? And that's kind of where we ended up getting into syndications and private funds and multifamily, because it was a better alignment also for not just our own money, but ultimately my skill set and Jennifer's skill sets from, doing leadership gigs and operational gigs in quote unquote the corporate world, even though I worked in a lot of smaller startups. So I know how to read a spreadsheet. I know how to work with people, structure partnerships. I just don't necessarily know how to swing a hammer. So it was a really, really good fit to go and figure out, how do we go and invest our money in something that could pay us an income and then eventually have a bigger outcome, paying us back a check at the end and then scaling it from there.
I love the fact that you brought this up, because it pinpoints on two things. One, there are so many different ways for you to make money in real estate. You don't have to be that active landlord. And I think a lot of people, what's maybe commercialized more is being an active landlord. But for those of us either still have our jobs or you're just not interested in that, there are other ways that you could be very passive and not have to deal with the day to day and still be in the game, still be in it. And another reason why I like what you said or brought this up is because it actually relates to my life. My wife and I's life. We both work, and I've been an active investor for the last couple of years. Done a few deals, owned about 6 up to 6 units. And what we've realized is, like, hey, what is a better way for us to not have to deal with, I just had a tenant today, water is not, it's cold and the AC went down. So I had to get that fixed, right? So that was like, part of my morning trying to get that situated. And so what we decided was to actually be private lenders. We're going to cash out on one of our properties, take the $100,000, and then just be private lenders and then ask for equity stake in certain deals. And even there's actually even syndications that you could just put in $50,000 and get started as well. So that's what we've learned. And I want people to kind of take that in this episode. Like, hey, there's different ways to get started in real estate investing or to transition over time and have an end game. So the idea is maybe start with a couple of rentals, get yourself, some learning lessons. And then if you want to be passive in a different way, you could cash out or build up the cash and do something else that fits your timeline, your family needs, so that you're not banging your head like, oh my God, I got to do this active landlording. It doesn't have to be the way, because even if you have property managers, that is still a job, because you have to manage those property managers, which I think people forget. They just go walk away. Some people, you get really blessed, right? And even if you vet them and they turn out decently at first, I would say nobody takes care of your property like you do. Mm-hmm. And so depending on what type of situation you have, you may find yourself really spending a lot of time managing your property manager or not, but definitely just things to take consider. Not something to discourage people from being active landlords. It's just, I think as you progress, you start to look at other things that maybe be a little bit more attractive and a little bit more release of your time.
Totally. Well, and I think there's so much I want to bite on there, but I'll just say, like, congrats on becoming the bank. I mean, ultimately private lending is a wonderful strategy in my opinion. And I think, like, ultimately it reminds me of a quote that I heard from a person who I met a few years ago in the real estate business, who just said, the end game here is to become the bank if you're talking about wealth creation and trying to be passive. And although it's oversimplifying it, but I do think it, that is one way that I would categorize that positively, is like, ultimately you're trying to, find the angle within a certain type of deal or strategy or asset where you can add value and do it over and over and find it reasonably interesting, and to your point, Anthony, I think, like, oh my goodness, like, investing actively is a job.
No, it is a job.
Full stop.
I'm at this desk a lot, actually, because of it.
Absolutely. And I mean, there's so many real time that I feel like people truly, I would say everyone should be encouraged to get into this stuff in real estate investing, unless you're going to treat it like a pure hobby. And in which, if you're active, if you're going to go try to flip a house and it's purely a hobby, and like, it's like, no, that project's got to be a job, man. Like you got to go in with that mindset, with that seriousness. But anyone can do it. Truly, anyone can do it.
So there was a quote, one of the people that I interviewed, where it was, I think it was episode 18. You could treat your job, if you treat your business like a business, then it will make money like a business. If you treat your business like a hobby, then it will make hobby money. It'll make $50 a month or something. So definitely you have to go in there with that mindset. I've been blessed enough to where I have a passion for real estate investing, passion for, I think, just business as a whole. But at the same time, I like spending time with my kids, and I see that you definitely do too. So
Yeah,
you
very
like
much
spending time
so.
with your family.
Yeah,
So
I mean, I try not to. I try to always caveat this rather, but I'll say like I'm a fan of rental investment still. Like we will in the coming years do it more. It has to depend on someone's goals and their context. Like to your point, like what you and I have in common, Anthony, amongst other things, is like we both have kids. I mean, we were just talking about soccer very briefly before we kicked off, but like it's
yeah,
soccer season, and like it's between the obligations of one kid and another, and combine it all with life, and that's a lot of demands. And so rentals are semi-passive. I don't care if you have a property manager or not; they will always be semi-passive.
yes.
And so I mean, and again, not discouraging people from buying them. I think they're great wealth building tools. But
Yeah, no, because without it, I wouldn't be able to do what I do now. So, and that's why I said like definitely recognize the stages in your how much money you actually have and what you can actually do. Because some people wholesale before they even get to buy their first property. They wholesale, do a few deals to stack up a down payment. Then they get into rentals, and then they find themselves doing burrs because they start off with turnkeys because they don't
yeah,
want the headaches of having to add value because that is repairs that they don't have to worry about. So there's definitely like stages to everything to where people finally get comfortable to say, all right, I want to do this next thing. You just have to figure that part out where you fit, where you want to jump in at. I've seen people I had one episode 54. The kid was 19 and his first deal was a syndication. It was a $1.5 million syndication. Like
that's awesome. Good for him. That's hard.
yeah. So wherever you can best fit into whatever niche in the real estate game, you don't have to start where everybody else started, or end up where everybody else started either.
Completely. Can I add one more thing on that real quick?
Yeah, for sure.
So a while ago we were talking about financial offense, and I think there's this fundamental concept which I think evaded me at first, and I wish I had gotten to it earlier. And I know I've gotten feedback from other people that they appreciate the simplicity of it, because I'm sure I didn't come up with this, but it's just something I tried to crystallize and use for our own household and our business, which is like there's really only two engines for building wealth that you really have to solve for. There's like the capital and getting more capital, and that sounds simple, right? It's like boils it down too easily. Go find some capital you can invest with,
Yeah.
and create something that generates more of it consistently. Typically, that's a job. More often, for people who want more of that, it's start your own business or start multiple businesses. So step one, generate a capital engine, like create some kind of capital engine. We're talking over a course of years here. So anyone looking for a next week get wealthy playbook, this ain't it. This is the slow wealth playbook. This is the playbook that wins.
Yes, it is.
It's like step one, capital engine. And that capital is going to go into something that actually can be invested. So then you're talking about the growth, like the growth engine from there. So just those two things, like the capital engine and the growth engine. The first one, you got to create the capital. The second one, you got to invest the capital, and then just rinse and repeat. And I know it's oversimplifying it, and people would probably hear that if they're new to this stuff, and they'd be like, well, that's not that helpful, man. Be like, that's exactly the point. Like so many people read a blog, they go and they listen to one story and they say, oh, that's a strategy for me. Be like, you have no idea what strategy is the right one for you yet. Yeah, you got to figure out, are you trying to get fully passive? Are you a brand new college grad? If you're a brand new college grad, please don't go try to invest in a syndication. And I'm not saying not that I don't want to work with you. It's because that will require just like you said, Anthony, like a $50,000 minimum sometimes. And no one sleeps well at night when that's an investment made in an illiquid investment with someone who's trying to get their footing. So anyways, sorry for the soapbox.
No, definitely these are things that I think everybody needs to hear as far as do's, don'ts, things to caution. This is not I don't want, when I talk on this podcast, I don't want people to think that real estate investing is like glamorized. There are some things that are hard. There are some things that are tedious. It definitely works out. Doing this has opened up so many doors, but I have worked my behind off in order to get where we got. So I want to make sure it's not, I want to be more realistic, and I'm glad that you've definitely been very transparent, but it's worth it. It's definitely worth it. So speaking of syndication though, so why do you believe that syndications are an underutilized strategy that professional busy people do not use?
Yeah. That this started for us just, to give a real-time story of, we didn't build this business out of the blue. It started super organically. And it was because we were looking for that strategy after we invested in rentals. And so we tried the small deal thing. We had already set goals together with Jennifer and I for our household to say we wanted to be financially free, meaning all of our expenses in life, kids, house, whatever, covered fully by a certain date. Mm-hmm. And we set that date far enough out so we couldn't use it as an excuse. All that context is key, Anthony, before I share this answer, which is like, we did the rental thing and we said, is this going to take too long? We had some capital because we had done well in a corporate world. So we weren't starting from ground zero, but we went and started investing in these things. And we were like, okay, it gets growth. You know, we had a stock portfolio. I'm not the guy who sits here and says, sell all your stock and go into something else, because that's not great advice either. It's about portfolio. Like, great investing is like an and, not an or, right? And so like, for me, syndications were checking two key boxes. It's like, is it fully passive truly? Like, do I not have to do anything if I invest, but other competent people will manage the thing for me after I've made my decisions and I've done my diligence? That's the one thing that I sometimes hear gossip from folks in my network. They'll be like, but it's not fully passive. You have to still do diligence. I'd be like, well, same thing with buying a stock.
Yeah.
You know, I hope no one's buying an investment of any type without.
I don't think nothing's that passive where you don't even have to vet it.
Yeah. And so that caveat in place for sure is, I find these investment vehicles to be legitimately passive. There are very few others, at least in the real estate space, can generate cash flow checks monthly that actually hit our account that we can use to pay for our life or any other kinds of investments that we want to make along the way. And then you can still get the growth. So cash flow and growth in one vehicle. Maybe I could find that in like a dividend paying stock, but usually it's not as compelling as the stuff that we have found. And so we started doing that. And then we realized, as we saw the distributions hit in our bank account, we were like, oh, this is real. You know, like this is real. I mean, granted, it all comes down to who you're working with. And it's kind of where the business organically started for us around our own investments. Is we had colleagues, friends saying, what are you guys putting your money in? Sounds like you're happy with it. Sounds like they're going well. And then we were like, well, wait, if everyone's asking us this question and no one has a really good way to go out and find the people that are really good at this and like vet the deals with a clear framework and all this stuff, maybe there's a business there. And then a few years later, here we are. And, you know, I don't have that career anymore. I left behind that whole career to run this company 5 months before COVID broke.
Oh,
so,
awesome.
That was, and so we were building this on nights and weekends after we kind of did our own passive investment thing. So that was probably way more than you wanted on that one. Sorry.
No, man, I love it. I love the information. If you want to call it oversaturated information, fine. I love it. So speaking of COVID, right? So how did that affect you and your business as far as syndicating these last 18, 20 months?
Yeah, I mean, that is a completely fair question. I mean, I think what's fascinating is like, we had been building the business for about 3 years on nights and weekends. I say nights and weekends. I'm more of an early morning guy. So it's like 4 a.m. mornings for 2 hours before I'd go into my day job every day. So I would say COVID was not nearly as painful as I think most people on the national news media and those who just digest the national narrative of market up, market down. You know, there's a lot more nuance than that in the real estate world. There's a lot more nuance than that in every type of market and industry. So multifamily has done quite well. I mean, like we focus on apartment buildings. We also focus on self-storage facilities, but to keep it simple, we just focus primarily on apartment buildings. And so helping, you know, we put our own money in alongside our investors and we help other people invest in these things. And frankly, right now, the values are stronger than they've ever been in the current market cycle. And so I do think that obviously it's a unique moment. No, I am not an economist. And by any means, I'm not a tax advisor, economist, or otherwise. But I will say that everyone was feeling pretty nervous around March and April 2020 on every possible front. And industry-wise, you know, every country was kind of watching where COVID's going to go, and it's still here and it hasn't really left yet. But right now, rents have now exceeded pre-pandemic levels. Property values far exceeding prior levels.
Yes.
And I would say that, for example, we have a lot of these syndication structures are typically like, you know, 5-year hold periods. You know, you invest and you wait 5 years and you get checks along the way, and then you exit at the end, you get a bigger sales proceeds check if it goes as planned. We have 2 so far this year that are 5-year holds that started in 2019 that are exiting now. So
why?
because the values are so high that they have already hit their year 5 pro forma.
Wow.
And so those are some happy investors. I spoke to one this morning. And so, of course, I am obligated to say here, that is not a guarantee nor expected on every
Yes.
project. I'm also
Yes.
registered
Good
with
disclaimer.
FINRA. Yeah, so it's very important for me to say these things. But I'll just say that these things have actually gone extraordinarily well. It does depend one click down on how well, depending on luxury A-class. I don't want to nerd out too hard on real estate here for folks if it's too deep, but like, A-class quality luxury, C-class property, workforce housing. There's different flavors and levels and types of playbooks to force appreciation on these properties ultimately. But yeah, it's gone very well.
Also, and I like how you spoke about the different classes enforcing appreciation. And then we all got a big bump over these last year and a half so that I didn't expect, which actually put a lot of us in a better positions than we thought. I was like, oh, okay, I have all this equity now.
Totally.
All this value. So it definitely was a nice surprise that gives a lot of more wiggle room. And I never even thought about it from the investor standpoint with syndications, people being able to exit out early, more, 3 years early than needed. So that was really cool.
Remarkable.
So the way it works is, let's say I give you my 50 grand and for a syndication and I expect 5 years, to get out. I get monthly checks up until those 5 years, and then I get my 50 grand back. How does that work for somebody investing in syndications?
Yeah, and I'll just speak to kind of the structure because there's like some market norms, which you'll find on the majority of the marketed kind of investment opportunities out there. But you just described it very accurately, I'd say, for the typical deal structure.
Okay.
And so, if you find a spot, I try to tread lightly on the terminology here. So tell me if I'm getting too nerdy on this.
Okay.
I think you'll have the person who manages these projects, the apartment manager and the GP or the sponsor or the operator. All of these terms mean basically the person who's putting together this real estate syndication. That's just a business entity that has the investors and the managers of the deal. The impassive investor, usually they'll have like a minimum of about $50,000. Sometimes it's a little lower. It could be like 25. I'm not the guy who's going to sit here and ignore a very helpful element in the broader market, which is crowdfunding platforms that have brought up the education around these things. So you've got dozens of crowdfunding platforms that are out there as well now. And, some people might say, oh, but you're competing with those. People like, you know what, man, like this is education on the topic is deeply, deeply needed across the board. And for some people, crowdfunding platforms are a great fit. And so for syndication investments such as these, you can go and invest around 50K. Typically, you'll usually see anywhere between like a 3 or 5, or on the longer side, a 7-year hold. And that means they're not liquid. So you can't just make withdrawals from it. Those funds are used to buy this big building along with a bunch of other people, other investors. You're going to force appreciation, like adding value to the property. And that's why I like these vehicles is like, I'm a business guy by trade. And compared to single family, one thing that's interesting is these are priced based on how they perform as a business. And so it's the net operating income. And that's driven by rents, that's driven by managing those expenses. And so that's really it. Like sales comps typically drive the value of a single family home. Business performance often drives the value and the market demand of apartment buildings. And so that's what you do. If I'm an investor, I entrust my funds with these folks. They go and add all that value, typically with renovation and better property management.
Mm-hmm.
And you plan to exit it, aka the cool way of saying you're going to sell that property at a targeted value that's higher in a X number of years, could be 5 years. And so at the end, usually you participate in like sales proceeds because you're a shareholder in that business that owns the property.
And so the main goal of a syndication is to eventually sell. Is that usually the main purpose?
Well, one of two typically. Like usually it'll be like a sale. Oftentimes you'll also have like a refinance where investors, perhaps the management group or team, wants to hang on to the asset, but they want to take care of their investors as well. And so one of the methods that's used is they will just take out a new loan. I mean, folks who are new to this can think of this very similarly to doing a cash out refinance. If you're familiar with that on a single family home that you might own, you're basically just going back to the lender, a commercial lender, and you're saying, look at all this value we've added. Let's take out a new loan. you're going to get refinance proceeds, and then that can be distributed out to investors as well as returning the capital.
Awesome. Yeah. And, that's got to be amazing to try to do a cash out refinance on that level, and looking at that deal to see, okay, this is how much, and we're talking about in the millions here, $5 million. Now we've added value. Now it's worth 10 million. Do a cash out refinance. I'm assuming that do commercial loans usually go at 75% loan to value?
What's fascinating about commercial debt, as a guy who started off in single family as well, is like, not only are sometimes the terms even more favorable for commercial, it's almost inverse of what most people would typically expect, but yeah, I would say ballpark, you're looking at around those terms, 25, basically think of it as 25 down payment, so 75 loan to value. But also you're going to see rates that are sometimes right now better than residential, which is always a head scratcher for me as a guy who personally did a cash out refi just last year. It's like the fourth we've ever done on our home. And I was sitting there going, how did a $40 million building just get a better rate than I got on my home?
I think that's when the economy is telling us what they want us to do.
That's one way to look at it.
I think that's how, yeah. When it comes to taxes or, rates and how programs like the 1031 exchange, for example, that's the government, that's the economy telling us, hey, these are the programs and the resources we want you to use, and we will give you incentives if you use them because it helps boost the economy. So
totally. I agree actually with that. Very much so.
Awesome. And I love talking about this type of stuff, man. Like this is pretty cool. So we've talked about syndication before on this podcast, but the way you broke it down into a wealth building playbook, I like, because I think it helps put people into perspective of the transition up into syndication. So in the past, I've talked about, hey, what is syndication? What are the roles? But in this one, we've kind of talked about like, hey, what's the mindset you need to have to be into syndication? What is probably some things you need to kind of go through to completely understand, hey, I'm ready to transition now to a more passive outlook. And like I said, people can always jump into it whenever they may and be successful. But I think a good rite of passage is to go through certain things. And then now I think your perspective and appreciation for these deals that you do now, especially for people like us, family men like us, to where I think this fits us. This niche fits what we're trying to do. And thank you for also explaining about or bringing up the possibility of if a deal works out very well, hey, getting out in 2 or 3 years early is definitely possible, but not guaranteed. So yeah.
Thank you for that.
And so I want to close things out with this final question, man. What is your rich state of mind? What is the big reason why you do what you do? You have such a rich history in real estate as far as with your dad, and then you were successful in the private sector, and now you've transitioned to being successful in real estate, and all in the name of either family or looking at how things, continue. I call it CPI, continuous processing improvement. So you've always improved on the process of obviously having a stable lifestyle, income, and being able to provide. So what is your big why? That was kind of long-winded. What's your rich state of mind?
I completely appreciate that, and thank you. Thank you for the kind words as well, Anthony. I think probably no shocker on this one. I'll give the personal, and then I'll kind of give the broader professional reason for why. First one would be, I'm a pretty simple guy on that level. I just want to be a great dad, and I want to be present. And I feel like in parts of my earlier career, I wasn't, and I never want to miss on that again, And so I think I walk my kids to and from school now. And so can't really replace that. And I'm always feeling pretty confident that that's a good call. And so I want to be a great dad. I want to be a good husband. I also want to be able to help those around me, including my family, if and when the need arises, which occasionally it does. And so on a professional front, I truly wish that I had known about this category of investment type earlier in my career. And I think I would have made a few different moves. I'm not anti-retirement account by any means. If people get a match at their company, I certainly would always use that myself. But I'm all about that usable cash flow now. And that is really where I'm excited to educate folks that we work with and that I just connect with in our network to help understand like a different way of investing in alternative investments, including syndications, but not exclusive to them. I think people tend to be very, very nervous about it, but they're comfortable going and buying a stock or even buying some crypto, like on a whim, but they won't go and consider something that's like a hard asset that's been in existence for hundreds of years. So it's a fascinating dynamic, and I want to help unbreak some habits there.
Awesome. And thanks for breaking it down the way you did, man. I really appreciate your transparency and just the back and forth, right, of how much we appreciate real estate investing and how we can even better and broader topic is providing more time for yourself and being passive and still providing income. Because I think if everybody had a choice, hey, if you could spend 5 hours a day at work and still make the same income you make today, would you do it? Everybody would say yes. So and it's definitely a way to minimize, 100 hours to maybe 25 and still make the same you make or even more. Just have to figure out different ways to do so. So thank you for your time. It's been pretty awesome, Spencer. Thank you.
No, thank you, Anthony. I really appreciate it. And this has been an awesome conversation. So thank you.
Thank you for sticking with us from the start of the episode. Please share our show with friends and family, visit our YouTube channel, and view more of our content on richstateofmind.com. See you next week on the Rich State of Mind Show.